Well, hello everyone. Happy Monday, I suppose. Don Garman here, checking in from Mirador Capital Partners after what has been an especially tense weekend. I'm sure we've all been made aware if you checked in at all over the weekend on any various news outlet anywhere that on Friday, one of the preeminent West Coast banks, Silicon Valley Bank, a 40-year-old, $200+ billion institution failed and was seized by the government. I will say, if it needs to be said, that Mirador Capital Partners does not have any kind of banking relationship with Silicon Valley Bank. However, many of the people in our community I know work there, and as someone who was at another financial institution in the last financial crisis, who through no fault of their own and the conditions permitted, watched the value of his own holding in that company go down a lot. I feel very bad on a human level for all of my friends who work at Silicon Valley Bank. These are good people. These are smart people. These are principled people. These were not conditions that they created, and it was through no fault of theirs that the conditions went away that allowed the bank to get over its skis in some very unfortunate ways. I'm going to explain a little bit about what happened, but I'm not going to belabor it. The weekend was filled with explanations of various levels of accuracy and vitriol from all directions, and I'm not going to retread that. But the reality of the situation is that the particular conditions of Silicon Valley Bank permitted lots of inflows into venture capital in 2021 when interest rates were very low. A lot of those landed at Silicon Valley Bank. So the bank, then awash in cash, had some options as to what they were going to do with that cash. Didn't make crazy speculative bets. However, with interest rates near zero, they did look out farther than 1 year on the yield curve to get more yield than the nearly 0% that was available that we all recall then. And so they bought some mortgage bonds, which are of very high quality, 7, 8, 9, 10-year bonds. And let me just explain in very simple terms how this mechanism works. All bonds, and I've talked about this many times to a lot of you individually over the weekend, are priced based on three factors, let's say. The credit quality, the chance that you're going to get paid back by the quality of the borrower, the interest rate environment, and the duration of the bond. So just to give you a simple example, if you have a 2% bond for 1 year and interest rates go up, it will go down by a small amount. If you have a 2% bond or CD or any other type of instrument for 10 years and interest rates go up, it will go down more because you have that 2% coupon for a longer duration. So what happened, the confluence of events for Silicon Valley Bank is the same time they took in massive amounts of cash, they invested a significant enough percent of it in longer term, high quality assets, such that as rates went up 9 times over the last year, as they have, it forced those bonds down in value. And their attempts to take some pain to re-shift those assets closer and get a higher yield created the beginning of a problem that one particular venture capitalist, who I shouldn't and will not name, catalyzed into a run that was fueled by the fact that we all now have instantaneous access via our phone to move money nearly anywhere we want if the other receiving accounts are set up, and many of ours are. So period, full stop, that's what happened. A few things I would note. You might recall an email I sent out many months ago saying this particular phenomenon, which is if you have cash at banks, you might consider moving it into higher yielding instruments, which you would also notice that's what we've done on your behalf in your strategies. there is a new investment that's been in there for several months now, a money market fund that is just this thing, which is instead of keeping a bunch of cash in deposits that are yielding a little, we move it into money market funds, which are yielding a lot more, and keep the minimal amount of cash that we need to, do whatever trading we're expecting to do. So I was actually told by a bank CEO along the way when we were describing this phenomenon. He said, I'm glad you're doing that, but I do hope that not everybody does that, because this is how we make an important amount of our profit. So the reality is how banks are reacting to this now. And again, I'm not going to pretend I know exactly which path this is going to follow, but this has a lot of hints of the last global financial crisis, where the pitchfork and torch mob go after each house in the village that they perceive, is having this same type of issue. So to set your mind at ease, you can look in your long view strategy, which of course is the cornerstone of our firm, and notice that we have no exposure to any but the most elite institutions. So you might notice the largest holding we have was the, I think, unassailably largest beneficiary of the last financial crisis as a result of some of the investments they made during those very, very tense times. I don't know that we're going back into those times. I think the government certainly attempted yesterday evening to take the worst case off the table. But I do expect that the market is going to test the soundness of that bridge and jump on it and shake it and rattle it and see if they can find any kind of cracks in it, because that is the way that these things go. They're going to, they're going to stress the system as much as possible to make sure that there are no breaches. And then I think that hopefully the storm will start to ebb and get back to something, on the bank side that's a little bit more calm. On the non-bank side, there's something more positive happening, which is the backstop of the deposits, the depositors of Silicon Valley Bank being made whole, then take a whole lot of companies that had been kind of tossed out last Friday, and now they're back in the good graces of the markets, which you will see today. If a lot of people who own a lot of financials and bank stocks are having a very bad day, thankfully, knock wood, we are not, and so that's I'm glad there's a sigh of relief in the sort of non-regional bank sector of the system that maybe this isn't an acute market-wide problem. I'm going to not even lean too hard into that statement at this point. So, wanted to just say I have been monitoring every bit of this story all weekend long. We never had more than minuscule exposure to any of the non-elite banks in the country, of which are, the cornerstone and the sort of bedrock of our capitalist system. To me, it makes sense. Some of this we've owned since the last financial crisis, and I don't think now is the time to determine that all banks forever will not be good investments. They generally have been very good investments. And so we'll kind of, hold our exposure to those and know that they will, in a very Darwinian style, more than likely come out of this even stronger, which again, that is part of the sad subplot of this era potentially, is that what has happened is really severely undermining the local regional bank confidence, which would tend to accrue to the benefit of the larger, more systemically important banks. So it's, here we go. It's March. We are, our fingers are crossed that this is just a flash fever here, or flash flood, and that nothing is seriously damaged, and that it passes, and we can kind of get back to all the other issues that we're monitoring, and there are several of those also. So anyway, I'll leave it there for now. If you have questions, please, as always, reach out, as many of you have. It was a text-filled weekend, and please keep that up. If you have concerns, that's exactly why we're here. And until then, I will talk to you soon. Thank you. Bye.